Okay, so you are welcome to lecture on IFRS 8 operating segment. What we are doing today is to try to cover IFRS 8. Then we will start with IAS that we will go back to do financial instruments. Financial instruments alone has like 3 standards. So we'll be doing IFRS 7, IFRS 9, and IAS 32. And we will see if time permits us, we go into IFRS 15 and IFRS 16. So this segment of the lecture starts with IFRS 8. It's a very interesting area. Normally, we've not seen it examined that much, but be careful. So we call it operating segment. All right. Now, let me give you the understanding, the background to this, so that when you are faced with an operating segment question, you will actually know how to go around it. All right. Now, you see, you've been learning. Let me write here an introduction to you so that you get it. If you are writing notes, you can make notes. You see, you've been learning consolidation. I think Bill has been working with you around consolidation, and he has paused for a while. But the essence of consolidation is that, you see, you have a parent, right? Normally, you have a parent company. Then you have a subsidiary. And you may have even another subsidiary. Now, you see, all these entities are entities on its own, but because of consolidation, you combine all of them and you prepare what we call a consolidated financial statement. So that is what we do. So you see, unfortunately, because it's a group account and you have combined some companies together, what you realize is that this one leads to the fact that, you see, the assets of the company, the assets, not only the assets, the liabilities, the income, the expenditure of all these companies. What do you do to them? You put them together. When you do this, question is that we had company A, B, and C, companies A, B, and C, which you have put together, and you've combined them and prepared a consolidated financial statement for them. But the question is that, and so we don't see the financial statement of these people. What we see is the combined one, the group, the consolidated one. So the question now is, how is each entity performing? How do you see the performance of each entity? How are they doing inside this consolidated financial statement? How will you know? How much is their individual assets and how much liability does each and every entity has? So how much assets? How much liabilities does each entity have? It's a question we need to ask ourselves, because we have prepared a consolidated financial statement. Nobody, it is in exams that you have the parent and subsidiary. You see in the financial statement, 20,000 of company A's asset plus 50,000 on company B's asset, then you get 70,000 and you write. This is in exams that is like that. But in the public sense or in the practical sense, you don't see it like that. All you see is assets 70,000. So how do you know how the individual entities are performing. And that is the reason for operating segment. That is why that is what has brought about operating segment. So now the standard operating segment reporting. Operating segment reporting, the aim of what we are doing now, the aim of the operating segment, the aim here is to actually deconsolidate the group financial statement. So what we are going to do is that we are going to deconsolidate the consolidated financial statement. Why? So that we will be able to review the significant information that are hidden when we actually put them together and prepare consolidated accounts. So the main aim is to deconsolidate, is to review the key information, the significant information, all right, hidden within the group. So from the consolidated financial statement here, we actually don't know how each and every entity is doing. We don't know. We don't know how each and every entity is doing. So we rather deconsolidate it. When we deconsolidate it, then we actually get to know what each and every individual entity is doing. All right. Now, you see, this standard is a disclosure standard. All right. So the requirement here is to disclose information about the entity. Why? To enable the users of financial information evaluate the nature of the business and the financial effect of their activity. You see, when the companies are combined and you prepare the group, if I'm coming to invest in the company, I'm coming to invest in a group, I mean, you don't really know. So let me make it more practical. You see, you may have a group of companies. The group is made up of entity A, B, C, and D. And when I prepare a group company, you see, this A may be in GH. This one may be in Nigeria. This one may be in GH and GH. So we have one foreign over there. Now, this one may be in the financial services. This one may be trading. This one may be oil and gas. This one may be service, normal services. So when you deconsolidate it, you now find out how each and every individual entity is performing. So if I'm an investor and I want to invest in a group of companies, probably there's one particular business entity that I can aim at. So when we deconsolidate it, what we are actually doing is to disclose information. Is to disclose the information. All right, so that users of the financial statement can be able to actually evaluate the performance of each and every individual entity. Okay, so it's for evaluation, all right, so that they can be able to provide economic resource to the entities. Now, so this is what IFRS 8 is about, operating segment. Let me hereby strike this warning that, and it's a very important note, IFRS 8 operating segment only applies to entities that are public. What do I mean by that? Entities which trade their equity instruments, i.e. their shares in the general public. All right, in the public market. What do I mean by that? In Ghana, it is SEC, right? So we are talking about public entities. So IAS 8 only apply to what? Public entities. All right, so that is that. So take note of that. Now, Now that you've understood what this thing is about, what IFRS 8 is all about, you now have a glimpse and understanding why a consolidated group of accounts, we don't really see each and every individual performance of the individual entity. So we want to deconsolidate it. So when we deconsolidate it, we will actually find how each and every entity is performing, so that the investor who wants to invest into the company actually get the ability to evaluate each and every entity separately and know where to actually invest. We've also mentioned the fact that IFRS 8 only applies to what? Public companies. When we say a public company, those who trade their shares to the market. All right, so that is that. So now, what then is operating segment? What is operating segment? So operating segment is a component of an entity. And like you see, I've stated here, sorry, they trade their debts or equity instruments in the public market. What then is operating segment? Operating segment is defined as a component of an entity. All right, I mean a component of a group. And that component of that group, number one, engages in business activities, which generates revenue and also incur expenses. So you see, it is not a cost center. It is both a cost center and what? A revenue center. So in impairment, we used to call them a CGU, a cash generating unit. They incur expenses, they also obtain revenue. So it's like a business, all right? So the part of any business, in a group of companies, we have head office. The head office normally do administrative works. They don't really do trading and things. They only do administrative works. So you see that for them, they don't generate revenue. All that they do is to incur expenses, incur expenses, incur expenses. But here, when we are talking about operating segment, what we are talking about is the one that can generate revenue and at the same time what? Incur an expense. And so we are looking at a business that does that, whose operating results are regularly reviewed by the chief operating decision maker. So in terms of definition of operating segment, these ones are key. You see, the standard is careful. First, it used to call them the CEO. Right now, we don't want to use the word CEO again. We call them the chief operating decision maker. So an operating segment number one is what? The component of an entity, part of an entity that's what earns revenue and incurs expenses. Number two, their operating results are reviewed regularly by the chief operating decision maker. All right. Like I said, it used to be the CFO or CEO, sorry. So you see, every year they sit down, they analyze performance and they review. So there is a regular, not only that, for which they can also prepare a financial statement. All right. So they can prepare their own financial statement, a discrete financial statement. So they can prepare a financial statement on their own. So basically what we are trying to tell you is that an operating segment is a business. You know, in your office, you have a business. You incur expense, you also generate revenue. Your performance is always reviewed by somebody. So we call them the chief operating decision maker. All right. Every year, I'm sure you do that. Not only that, you also prepare financial statements on your own. So if you do that, plus the fact that you trade your debt and equity at the public market, then it means that you are an operating what? Segment. You are an operating segment. All right. Now, to be able to identify an operating segment, okay, we have two means of identifying operating segment. Two means. So identification of operating segment. In the normal days, we will call it recognition. How do you identify operating segment? There are two ways you can identify an operating segment. We have the administrative way and we have the quantitative way. So qualitative and quantitative. All right. So the administrative one is the one that we have done. The administrative one is the fact that their performance are reviewed by who? Their operating results are reviewed by the CODM. So that is a way you can identify chief operating decision maker. That is a way you can identify an operating segment. Another way you can identify an operating segment is what we call aggregation. We use aggregation. And that one is not a way of actually identifying an operating segment. It is under kind of the administrative way of identifying an operating segment. So aggregation becomes very key. What do we mean by aggregation? So aggregation is under the administrative. So the second one will rather be what we call the quantitative threshold. So we will look at that, the quantitative threshold. We will come to that. So if your financial statements are reviewed by a chief operating decision maker, then that's fine. All right. Then under that, we talk about aggregation. Now, what is aggregation? So we are saying that two or more operating segments can actually be put together as a single operating segment. Two or more can actually be put together as one operating segment when they have similar economic characteristics. Now, when I did this example for you, you cannot put these companies together. Why? Why? Because this one is in financial services. This one is in trading. This one is in oil and gas. This one is in general services. So they are not the same. You cannot put them together. But aggregation is possible when the companies have similar characteristics. What are the similar characteristics? Similar characteristics in terms of the product and the service. All right. So if this one were to be financial services and this one to financial services, then you can put A and B together as one operating segment. Not only that, you can do that only if their production processes are the same. So product and service are similar, production process are the same. Their class of customer, their classes of customer too are the same. Then their distribution model is also the same. If that one happens, then you can use what? The aggregation. It means you can combine similar entities like that as one operating segment. Let's look at this illustration so that you understand what I'm talking about. Let's look at this illustration. Now look at this. eGames is a UK-based company. I mean, let's make it a UK or Ghanaian-based company. All right. Now, eBase sells computer games. And at this point, I'll ask you questions so you may be able to raise up your hand and answer me so that I know that you're actually listening to me. You see, eGames sells what? Computer games and also hardware. Sales are made through the eGames website as well as through the high street stores. So let's say Accra High Street or Tema. All right. So it's either they sell the thing at the website or they also sell it at the physical store. The products sold online and in the stores are the same. It's the same product. eGame sells new releases in the stores for 40 cedis in its stores. But for 30 cedis, in 10, but for 30 cedis online. So if you go to the store to buy, it's 40 cedis. If you buy it online, it's 30 cedis. Internal report used by the chief operating decision maker shows that the result of the online business separately, the result shows the result of the online business separately from the stores. However, they will be aggregated together for disclosure in the financial statement. Your job is that should the online business and the high street business be aggregated into a single operating segment? That is the question for you. On what basis do we say you can aggregate them together? Do you remember these? These are the bases. Is the product and the service the same? Is it similar in economic characteristics? And is it similar in these ways? Is the product the same? E-game is the same, right? True or false? Whether the store or the online, the product is the same. Producing the product, please, I want to hear your voices. I want to actually hear your voices. So when I ask the question, kindly try and answer me, all right? So is the production process the same for the game? Is it the same?
Is it the same?
It's the same.
It's the same. All right. What about the class of customers? Is it the same for this product?
It's also the same.
It's also the same. What about the distribution method? Is it the same?
No.
So the distribution method, one is what online and the other one is what on the store. Because of that, we cannot say we can aggregate it. So the question as to whether we can aggregate it into a single operating segment, the answer is no. Why? Because even though this one is the same, this one is the same, this one is the same, this one is not the same. All right. So we cannot make it an operating segment. Yes, John Mark.
So do you have to meet all the criteria before you aggregate?
Yes, boss.
Okay, thank you.
That is that. You have to meet all the criteria. So it means that you have to actually know the criteria. All right. So that is that. That is that. So you see that I've provided the answer for you. Those of you who have the book, you see that that is that. So in conclusion, this means that they might be appropriate to disclose them what separately. This is a disclosure standard. So the tutor advice that I give you is that there is no right or wrong answer here. It's just that you need to position yourself and explain why it should be combined together or it should not be combined together using what? The standard. All right. So take note of that. All right. So that is how we talk about in aggregate when in terms of aggregation. Now let's now come to the second way of identifying the operating segment, i.e., using the quantitative approach. So this one is the qualitative approach. Now let's come to the quantitative approach. Now the quantitative approach is tricky. It's very, very tricky, and you need to listen carefully. So how do you identify? We use the quantitative approach. The quantitative approach, that one you need to bring in your calculator. How do we see an operating segment? We can see an operating segment, number one, when that segment's revenue, so the segment revenue is actually greater than 10% of the total revenue. I mean, the consolidated revenue is greater than 10% of the total revenue. So if the segment's revenue is actually greater, so it's a procedure thing, okay? So you first check the revenue. You check the revenue. When you check the revenue, and it is greater than 10% of the total revenue or the consolidated revenue, then that is your first step. You see that you've done the first step to identify it. Step 2, also, if the segment profit, is also greater than 10% of the total what? Profit, the total group profit, then it's another way to identify an operating segment. All right. Step 3. Step 3, if that segment's assets, the segment's assets is also greater than 10% of the total group assets, the total group assets. That one too is a way you identify operating segments. And so that is what you see here. Then most importantly, step 4, the overriding one, is that at least 75% of the entity's total external revenue must be included in the reporting segment. You see, it's a group of company, which means that they can be trading among themselves. You know, you've heard of it before, sometimes transfer pricing and all those things. But we are talking about the fact that at least 75% of the entity's external revenue. So we are not looking at the total revenue. We are looking at what? Only external revenue must be included in the operating segment. If the total reported revenue is not greater than 70% of the external revenue, then additional operating segment is required to be disclosed. So what we are saying is that, first of all, check the at least if it forms 75% of the external revenue of the entire group. So this is it. At least 75% of the entity's external revenue must be included in the reporting segments. Other segments should be identified as a reporting segment until 75% of their revenue is also reported. Let me give you a pure illustration of this so that you can actually appreciate what I'm talking about. Now look at this illustration. That's what we're going to use. Look at this illustration. The management of companies have identified operating segment based on the geographical location. Information is provided to you below. You see, this is the total revenue. And in the total revenue is made up of external revenue, 140, and internal revenue, 120. We have profit or loss for the group. This is it, and this is the asset. You remember we said required according to IFRS 8, which segment must be reported as operating segment. So first of all, quantitatively, we said 10% of what? The total revenue, segment revenue should be greater than 10% of the total revenue. What are the segments we have? We have Europe, Middle East, Asia, North America, Central America, and South America. Now, look at them. Look at them. So this is the total revenues. These are the revenues you have. This is the total revenue of the entire group. Now, if you ask yourself, which ones have, so the 10% you have to do to find out if a segment, any of these segments have, greater than 10% of the total revenue. Yeah, so, yeah, some of these houses have Conscious Man.
Yeah, sorry for drawing you back. Please,
Right.
The quantitative, the criteria, do you pick one and conclude, or you go through all the 4 and then finally...
You have to go through all the 4 because the person's revenue may not be, but the profit may be.
Okay, thank you.
All right, so like the example that we are doing now. So let's try the revenue, the total sales. So if we check 10% of the total revenue, this is the total revenue. 10% of this total revenue is how much? 100,000, right?
Sure.
So if it is 100,000, this is 1 million. So 10% is 100,000. Then which of the segments have their revenue being higher than 100,000? You see, by this one, we will have Europe, won't we? Europe is 260.
Asia.
You have Asia, North
America.
America. So these three. So we had Europe, Asia, and North America. Then what about the profits? Look at their profits and tell me which entities are there like that. 10% of the profit. This is the profit, right? Total profit. 10% of the profit should be 23,700. Is that not it? So if you check that one, which ones exceed?
North America.
It's what? It's total profit. I think there are losses inside. Let's take off the losses. This is loss. This is profit. There are losses, so it won't be 23,700. We need to, the standard set profit, it didn't include loss.
Oh, okay.
So if we pick this one, we will make a mistake. So it will be profit this, and profit this, and the last profit this, right? So when you combine, okay, so the combination is even here. So 98, 47, 121, and 12,000. So when you combine, you should be getting 27,000. 200 and it should be 278. Now, when you do 10% of 278, you get 27,800. Please, do you understand what I've done? Do you understand? We are looking for 10% of the total profit. It's profit. It's not total profit or loss. 10% of the segment profit. So loss is not an issue for us to consider. We will treat the loss separately, the loss segment separately. All right. We will treat it separately. So that is what I've done here. This is the loss-making segment. You see, you combine that one to loss is what? So if you have anyone whose loss is also like that, then that one is different. Therefore, we say all segments making profit or loss is greater than what? 2,700. So we need to separate them. Of course, even if you combine it and make it to 23,700, we are looking at those people whose profits will be exceeding 23,700. Of course, the lost ones, already they are lost. There is no way they can get there. Please, are you getting it? That is why we single out the profit ones. So looking at the profit, yes, sir.
Please, why are we picking I guess we are picking the figures from the profit or loss column.
Yes, please.
The 237 column. That's why we are picking the profit. Individual profit.
This is the column. This is the the total is what we are looking at. The total. This is the total. Are you seeing the total?
Yeah, it's 237.
But my point is that you cannot include the loss. So because the losses are in, that is why I've taken the loss out.
So why? Are we taking the 26 and 15 out of the 237?
Exactly, that is all.
But I'm not getting the 23.
When you take it out, you get 27,800. Is that not it?
The two figures are 40. Okay, well, let me check.
What you are doing, what you are doing, you should add it back. You don't deduct. I mean, how can you pick this one and still deduct what you have deducted before you had this one? You are saying you have picked this and you are deducting this and this again. If you if you take these ones out, this is the final answer you should be getting. You should be getting 278,000. 278. 278.
Correct, sir.
Exactly. And 10% of 278 is 27,000.
27.8.
Yes. That is what we are doing.
Okay, thank you.
All right. So now that you have it, which one exceed that 27,800? So which areas would that one be using that one? Which segment would that one be? You see that this one is greater, this one is greater, and this one is greater. So all of them are greater. Who are those ones? It's Europe. And which one? Asia.
North America.
And which one again? And North America.
North America.
So it's the same three people again. Good. The next one is what? Segment asset. The segment asset should be greater than 10% of the total. This is the asset. 10% of this one will give us what? 1,000. Is that not it?
Yes.
Yeah. So which ones has their own exceeding 1,000?
Europe. North America.
North America. So these are what we have. So that is what you see here. If you are left with one, right? I'll come back to that. So have you seen what we've done? So this is the asset aspect. And that is what we've put there. So by the 10% test, so we have two tests. This is the 10% test. That is what we've done. This is the 10% test. By the 10% test, we have been able to identify them. So these are the people we identify. So based on 10%, we have who? Europe, we have Asia and North America. Europe, Asia, North America. So you see that when you go through the test, you can pick all of them. Now, once you are done and you finalize these three people, you now come and do what? The 75% test. What does the 75% test say? It says that at least 75% of their external, 75% of the entity's external revenue must be included in the reporting segment. 75% of the entity's external revenue must be included. Now watch this. These are the ones that we picked, right? Europe, Asia, North America. What are their external revenues? So you see external revenue is here. So 140 Europe, 150 North America. Then which one again? Asia. So 150 is Asia. North America is what? 195. So that is, so you see you have them here. 140, 150, 195. These are, and the total is what? 485. 485. Now, what we are saying is that how much is this 485 out of? So we say at least 75%. We need at least 75%. So when we combine these people, we have 485. But what is 485,000? What is the total external revenue? What is the total external revenue? 612. Have you seen it? So we want to see how the percentage. If we do that, we have 79%. So it means that the 75 test is met and other segments needs to be reported. So in conclusion, we say that operating segment in this entity, that should be reported separately. So it means that after you have done your consolidated account, you need to report on these ones separately. That is what we mean by disclosure. So you report them separately because they passed the test. They passed the 10% test and they've passed the 75% test. So it means Europe, Asia, North America must be disclosed separately. That is all that you say. That is all that I say. But you see, before you can do that, you need to go through the qualitative steps and the quantitative. So whichever one that you are going by, so you select. I mean, when you are done, you disclose. What are the information that you are going to disclose? The general information that you are going to disclose is the factors that is used to identify the operating segment. Did you use quantitative or you use qualitative? You need to disclose it. All right. When you use the quantitative, which measure did you use to select them? Did you use the 10%, greater than 10% of revenue, or greater than 10% of profit, or greater than 10% of asset, and the 75% test? So you have to disclose the process you use. All right. So, and where is the company? The geographical place, then is any measurement criteria that you selected. So all these things are here. So once you are able to identify the operating segment, then you disclose these informations about them. How did they measure their assets? All right, and all those things. Now, segmental reports have some limitations. Okay. And these are things that you need to understand. There are a few limitations around this. Because intersegmental sales can happen, which can increase if you are using this one, intersegmental sales can increase their total revenue as well as their profit. So if they trade within themselves, even though their revenue is increasing, you see, it is within themselves. So they trading within themselves may distort the operating segment. That is one of them. And number two is subjectivity. You see, subjectivity, like the way we are talking about, are you using the qualitative perspective to do it, or you are using the quantitative? Since you have a choice, there is always what do we call it? Bias. All right. Yeah. And we also talk about the fact that there are common costs. You see, in terms of using their profitability, there are common costs. There are common costs. A company that may be doing well will be paying the same administrative expense to head office, whilst the big company too is also paying. So there is a common cost amidst them. So how they actually share the common cost affects the profitability also. And you are using profit to identify this one, the operating segment. You see, the key thing you should understand is that the reason why we are doing this, like I explained to you, is because of what? The investor's perspective. Because the investor wants to know which entity is performing well so that he can actually direct his investment. If you put the company together and prepare group financial statement, he won't know. He won't know which one is doing well or which one is doing bad. So you need to split them so that he can be able to identify that one. Now, I'm leaving this question for you, and it is in your book. I just have two questions for you. It hasn't been examined before. And ladies and gentlemen, if it is coming, these are the two questions that will be coming. These are the two questions that will be coming. If it is coming, these are the two questions. Your question one is this. Your question two is this. So please, you have the book where you don't need to cry over it. Go through it. I've provided to you the 9 solutions. This one is about, the B part of this question is about aggregation. Discuss whether it is appropriate to aggregate segment A, segment 1 and 2 in reference to, on what grounds do you aggregate? Do you remember? The product and service should be the same. The production process should be the same. Class of customers should be the same. Then what else? Their distribution channels, the same. If you test in the question and it's not the same, you just say yes or no. But before you can say yes or no, you need to mark them against what? The 4 recognition criteria. That is what you need to do and provide your answer. So if this thing comes, it's just a simple way to get your 4 marks. This one too says that SA has 3 distinct business segments. Management have calculated the net asset, revenue, and profit before common cost. Do you remember I said that sometimes there are common cost allocation in there? This one, the profit that you have is before common cost, which are allocated to this segment. However, they are unsure about how they should allocate the common cost, whether they can exercise judgment in the allocation process. They wish to allocate the head office management expenses like pensions, head office management expenses, cost of managing properties, interest, and related interest-bearing assets. They are also uncertain as to whether the allocation of cost has to conform to the accounting policies used in the financial statement. Advice. Come on, this one, you don't even need financial reporting to do this. What will be the basis of sharing something like management expense? It's how often you use the management expense. How will you use pension? Distribute pension. Is it not the number of staff you have in your office? Cost of managing properties. How many properties everybody is having? Interest-bearing assets. Then what are the interest-bearing assets that you are holding? So that those are the things you say to be the basis for sharing those costs. We are looking for the basis of sharing cost. Do you remember when you were in senior high school or wherever you were, you used to do cost allocation in costing, if you remember? Overhead absorption. You share it. What were the bases? Maybe a floor area, square meters, blah, blah, blah. This one too, the same thing. Management expenses. How often do you use management expense? How often do you use the head office management? Pension expense. Pension expense is on staff. So how many number of staff? So those are the things you say, and I've expounded on them in the solution for you to deal with. All right. Then we have clan set. This one too is an ACCA question, and they are not many. So if these things are coming, then be careful. These are the only two questions you may be encountering. And please, this is IFRS 8. It's not difficult. Don't miss an 8 mark just because of this. We've explained this to you. You see, this one, they are saying clan set is uncertain as to whether the research and development laboratory should be reported as two separate segments under. So we are looking at aggregation, the same thing. Should it be different or it should be put together? So you have to go through it. And I think, you see, they've given you some percentages. So go through it. The solution is there. Try your hands on it. It's not difficult. All right. So go through it. Because of time, we cannot solve all past questions. We can't do that. But that's why you bought the book. So I think you can manage yourself around it. So that is it under operating segment. Any question under operating segment before we move on to our next standard? Any question? Any question? Any question?
Hello, sir.
Yes, please.
Yeah, please. So the quantitative method, after conducting the 10% test, what if the 70, the last method, if you do the 75 test, it doesn't meet. Let's assume that after.
If the total reported segment revenue is not greater than 75, that is your question of the external revenue. Is that your question? If it is not, then additional segments are required to be disclosed. And I think I made that point here. The line dropped off. I think that is the question he wanted to ask if I was following. So I made that point here. So if you have, so we say that at least 75% of the entity's external revenue must be included in this. Other segments should be identified as reportable segment until what? The 75% of the external revenue is reported. So the other segments, what we are saying is that additional segments are required to be disclosed. All those ones. All right. If not, you disclose additional. So we are saying that if they are not there yet, so we are information about the business activities and operating segment that are not reportable are combined into all other operating segments. So we are saying that disclose and all other, it is not up to the 75%. So we are saying other segments should be identified. So identify other segments as reportable segment until the 75% revenue criteria is met. All right, so I'm guessing that was your question. Who was that? Who was that?
Yeah, I'm okay now.
You are okay now. All right. That's Nibata, right?
I'm okay now.
All right.
Yes.
So that is that.
Yes, yes.
All right. So, ladies and gentlemen, that ends operating segment. It's a disclosure standard. We don't waste time on it. All right. So let's move on to another standard.